Hello everyone, welcome to the FinTech. This is Steve, and in today's video we're going to learn about how two banks in US collapsed over the last week and if this is the first domino that would cause worldwide recession.
Well, all right, tough stuff. Well, the collapse of this Silicon Valley bank, is this going to cause a financial meltdown? Bank stocks getting hammered, the whole stock market's getting hammered.
Of what was a tech-focused lender in the Valley. Many called it the backbone of Silicon Valley, lost nearly.
First thing first, what happened? Two major banks collapsed over the week in US, SVB, which is also known as Silicon Valley Bank, and Silvergate. In this video, we'll be focusing on SVB since that's the most relevant to our Indian economy and Indian market. The closure of Silicon Valley Bank was announced by FDIC on Friday, marking the worst US financial institution failure in 15 years since 2008 crisis. SVB was a reliable bank that had a great reputation with startups. Many of the startups had their payrolls tied to it, which are unfortunately now in jeopardy. SVB was the 16th largest bank in the United States until Friday afternoon, and it failed once the depositors started withdrawing their cash from the bank after the rumors got out on the bank's health. SVB is connected to many startups in Silicon Valley. One of the startups which had great relations with SVB was Y Combinator, which is a startup incubator that launched Airbnb, DoorDash, and Dropbox, and they regularly referred entrepreneurs to them. Now, the SVB and Silvergate banks collapse is pretty similar to the 2008 crisis, but experts say this is only limited to crypto and startup industry. Now let's see, how did this collapse even happen? To understand this, you need to understand how banks work. All the banks usually loan out 70 to 90% of their deposits to businesses and people. During the pandemic, the startups who were flooded with fresh investments had parked their money with SVB. Now, since the consumer spending was halted, nobody really required loans at that point, and SVB ended up sitting on this huge pile of cash. Now, they started investing this huge pile of cash into government bonds. Now, government bonds are usually safe, but unfortunately for SVB, this was bad timing. US Federal Reserves had to increase the interest rates in order to tame down the inflation, which eventually tanked the government bonds. Now, usually banks have two options how they invest in government bonds. Number one is available for sale account, and number two is hold to maturity. Number one, which is available for sale account, basically means that you can liquidate your bonds at any point of time and give that money back to your customers. And number two is hold till maturity. SVB unfortunately went for the second option, which is hold till maturity. SVB didn't keep their bonds in AFS, as by regulatory standards, they had to declare the price of the bond each day and how much reserves they had on the balance sheets. Now, since they were in heavy losses since the government bond plunged, they didn't want to show that to their clients. Hence, they opted for the option of hold till maturity, where they had to hold the bond until they mature. Now, if you actually hold a US government bond until their maturity, most of the times you get your returns back. But this wasn't the case here for SVB. The hold till maturity strategy only works when the depositors hold their cash with you for a long duration of time, and that cash is always invested into the bond market. But the moment the whispers mongered that the bank is in trouble, all the depositors requested withdrawals. Now, SVB could have easily converted their HTM bonds to AFS and sold them and returned their depositors' money back. But this would have meant that they would have to take colossal losses on their balance sheet, and which they couldn't pay back. So instead, they did what every other bank does. They just called up customers saying not to panic and pretended as if everything is normal. In the meantime, they pledged their depositors that they would raise a new capital, but unfortunately this didn't go down well, and the depositors continued to withdraw their cash, which caused a bank run. Now, a bank run happens when many customers are concerned about the solvency of the bank and their deposits and all go out to withdraw cash at the same time. This drains the bank reserves, as the more the customers try to withdraw the cash, the more cash drain happens, and eventually the bank will not be able to meet the transaction request of a customer. Now, SVB had a lot of cash. There was no problem of cash flow. The only problem was how they diversified the cash flow into investments, which eventually led to the downfall of the bank, the domino effect. Now, nobody knows yet what the contingency of SVB was with other financial institution or other banks. But if you're a company which banked with SVB and had parked all your deposits with them, it's obviously not good news for you. Yes, the deposits are insured up to a point, but they are obviously not 100%. So far, the experts think that this is not as bad as 2008, but we shall get to know soon. What are the possible repercussions? Number one, renewable energy. SVB used to fund almost 60% of loans for the Silicon Valley solar companies. But unfortunately, the funding will stop now, which could hamper the US sustainability growth, which they aim to achieve by 2030. Number two, layoffs. Many startups who have their deposits parked with SVB have now been frozen, and this means that they will not be able to pay their employees starting next month, and this could lead to massive layoffs. It is predicted that over 2 million people might lose their jobs. Number three, tech industry. Tech industry used to borrow a lot of cash from SVB, and that unfortunately will stop now, and we would see a lot of startups or mid-sized companies unable to sustain. Number four, other banks who have lent SVB might be exposed financially, and this would lead to worse outcomes in financial sector. How does it affect us? India's stock market had a strong start to the week, but fell on Friday after SVB's news, especially the banking sector lost a lot of money. Now, Monday morning is going to look bad, and we might see it stabilize on Tuesday once there is some news on SVB from US. Now, hopefully, Elon Musk or other US banks who have showed interest in buying out SVB and bailing them out might just come to our rescue. Now, this crisis will affect India's tech companies and India's SaaS companies such as Bluestone, InMobi, Paytm, Shaadi.com and Naptol, which have their capital held with their troubled lender. Now, the other issue is if there are other financial sectors exposed to SVB, it might cause a domino effect as seen in 2008 and lead to a financial crisis, which eventually leads to a recession. Now, our government can take a learning out of this and be careful while increasing interest rates, as increasing too much interest rates is also not too good for economy. On the other hand, the bank regulators can now keep a track of all those banks who had a lot of cash sitting on their side during the pandemic and regulate them to avoid such a scenario happening with an Indian bank. Final thoughts. Our stock market has been correcting itself for 3 months now, which is longer than the regular 2 months correction. But if you're a long-term investor like me, this shouldn't matter to you, as historically the market has always gone up. Continue your systematic investment plan and keep investing month on month, no matter what the market is doing. In fact, such markets make new millionaires. History is repeating itself, and it's your time to shine. Leave your comments below sharing your thoughts on the SVB saga, and if you think that this is a repeat of 2008. I hope you liked the video. Please take out some time to like, share and subscribe, as a lot of effort goes in making these videos. This is D signing off from the FinTech. Thank you.